Okay, let's dive into this. So there's this new idea floating around to make buying a house way more affordable. Sounds great, right? But there's a pretty big catch. And that's the question we're going to tackle. Is this 50-year mortgage plan a dream come true for home buyers, or is it actually a really, really costly trap?
Okay, look at these two numbers. They seem like they can't both be true, but they are. They come from the exact same proposal. On one side, you save about $319 a month. Awesome. On the other side, you pay an extra $474,000 for the same house. So what is going on here? How is that even possible? Well, that's what we're going to unpack. So, let's get into what we're calling the $300 a month question. I mean, look, in today's housing market, every single dollar counts, right? So the idea of lowering your monthly payment, well, that's incredibly appealing. And honestly, that's the whole hook for this entire plan.
I mean, let's be real. With home prices and interest rates where they are, buying a home can feel almost impossible for a lot of people. So you can see why, when a plan pops up that promises to slash your biggest monthly bill, it's gonna grab some headlines. But how it does that, that's where the story gets really, really interesting.
Okay, so what is this plan anyway? Let's really break it down. What is it, who came up with it, and what's the big idea behind it?
Okay, so the first thing to know is that this is just a proposal that was floated during the Trump administration. It's not a real thing yet. The idea is that the government would back these 50-year loans, kind of like they do with FHA or VA loans right now. And the goal is super simple. Just stretch out the payments over a whopping 50 years.
And the official goals? They're pretty straightforward. Number one, obviously, lower your monthly payment. Number two, help more people actually qualify for a loan in the first place. By lowering that payment, it helps your debt-to-income ratio, which is that magic number banks look at. And third, on a bigger level, it's being pitched as a way to tackle the whole housing affordability crisis we're in.
And hey, don't just take it from me. Here's a quote directly from Kevin Hassett, who was the director of the National Economic Council. He put it really simply. It's about reducing that monthly payment to, in his words, help people get back into homes. It's all about that immediate relief.
Okay, but there's got to be more to it, right? Saving a few $100 a month can't be the whole story. And you're right, it's not. This is where we get to what I'm calling the $500,000 catch. This is where the long-term reality of this thing really hits you.
So first, let's look at the hook, the bait. The math works out that on a typical house, you'd save around $319 every single month. That's almost $4,000 a year back in your pocket. Think about it. That's money for groceries, for saving, for anything. Sounds amazing, doesn't it?
But here comes the catch, and it's a big one. Over the entire 50-year life of the loan, you end up paying an extra $474,000, just in interest. That monthly savings, it's not free money. It just gets tacked onto this huge mountain of interest you pay later on.
Now, let's really dig into the numbers on this slide because this is where it all clicks. We're talking about the exact same $450,000 house with the 50-year loan. Yep, your monthly payment drops by $319, but then look at that row for total interest paid. It jumps from around $500,000 on a 30-year loan to over $1 million. $1 million in interest. So the total cost for that same house, it goes from just under $1 million to almost $1.5 million. Wow.
Okay, so it's a pretty clear trade-off, right? A little bit of relief now for a whole lot of costs later. Let's just lay it all out, side by side, the pros versus the cons.
So on the plus side, it's all about getting your foot in the door. Lower payments mean it's easier to qualify. You get a little more buying power. But the drawbacks, they're pretty serious. And it's not just that huge interest cost. Maybe the biggest problem is how incredibly slow you build equity. The part of the house you actually own. And when you build equity that slowly, you're at a much higher risk of going underwater. That's a scary situation where the market dips and suddenly you owe more on your loan than your house is even worth. And with a 50-year loan, you're stuck in that danger zone for a much, much longer time.
And this chart, wow, this really shows you what I'm talking about. Look at this. After 10 years of making payments, with a 15-year loan, you'd own almost 2/3 of your house. Solid. With a normal 30-year loan, it's about 17%. Okay, but with a 50-year loan, after a full decade of paying your mortgage every month, you would own a tiny 6% of your home. Just 6%. Almost all of your money has just been going to the bank as interest.
The investor Kevin O'Leary, Mr. Wonderful, he puts it even more bluntly. He basically says, with equity like that, you'll never really own the home. It's like you're just renting from the bank for 50 years, except you're the one who has to pay for a new roof.
All right, so it's pretty clear this proposal has some major red flags. But remember, it's just an idea for now. So let's talk about the real world. If you're hoping to buy a house, what should you be doing right now?
Okay, first and most important point. You can't get a 50-year mortgage. It doesn't exist. It's a political talking point, not a product you can apply for. The law currently caps government-backed loans at 30 years, so it would literally take an act of Congress for this to ever become a reality.
So instead of waiting around for that, here are 4 much smarter things you can actually do today. First, don't put your life on hold for a political what-if that might never happen. Second, put all your energy into getting the best interest rate you can. A lower rate is way more powerful than a longer loan term. Third, look into the government loans that already exist, like FHA and ZA loans. They're specifically designed to help people buy homes. And finally, number 4, check out assistance programs in your state or city. You'd be surprised how many grants and loans are out there for first-time buyers. They can be a game changer.
And all of this really leaves us with one big question, doesn't it? This whole 50-year mortgage idea, it definitely shows how much people are struggling to afford a home. But it makes you stop and think. Is the real answer just to stretch our debt out for even longer? Or do we need to find better, smarter ways to fix the real problems that are making housing so expensive in the first place?